Well, my friends, it's Friday, and this is Friday Market Watch. I've decided to do this as a vlog today, which makes my life so much easier. And let's start right getting into all the different details about how the market fared this week, and we'll see. We'll shape everything, and then we'll take a look ahead and see what we're in for with the Dow and the S&P 500 and the Nasdaq, and we'll try to shape it all into a nice package. First off, I wanted to talk about the jobs data report that just came out. It's September report that shows a minimal increase in jobs in America, about roughly about 165,000 new jobs have been added in America, which is very dismal in comparison to what normally is the capacity of about 440,000 new jobs created on an average. So you get this a definite variable in how the jobs report is being speculated out there, and with the current economic data the way it is, you're seeing that this investors are being told to not buy on the dip down, to wait and see before they invest in the market again. Everyone knows I'm a contrarian, and I buy on the bottom side, and so if you read my blog at all, you realize that you start making money when the bottom falls out. You buy on the bottom, not on the top. So with the current underpinnings that are in the market and market volatility, you have a lot of sensitivity in the market presently with this jobs report. You're going to see a major economic impact from the jobs report going forward into after the vacation, with Monday being a legal holiday. You'll see when the bell rings for morning business on Tuesday, a significant change in the way the market is viewed by both institutional investors and by big companies. You're already seeing the swing in many stocks being downgraded by Moody and by Morningstar, the two very well-known rating companies on the market. On the Dow actually, and also with Nasdaq and S&P. You see a significant drop of this week on average, 265 point free fall drop. That's going below the belt line, ladies and gentlemen. We're all the investors are being told to bail out. I don't agree with that. As I said in the previous part of this piece, this is the time when you got to start buying in. There's all that cheap stock that is floating around out there, and you got to take advantage of it. That's why I'm always a mouthpiece for something totally different. You see how economic data is also affecting the Fed too. You see that the Fed is already actively controlling the money system, the money supply, by shrinking the previous policy and rolling that back they were doing a mother load of really loose financial policy, bloating the market. Now with the new Fed chairman, the Fed chairman, is saying, well, we're going to increase the discount rate, which is the rate in which money is transacted in the market. Going to be another 1.5% increase, rate hike increase, coming very soon, coming at everyone, and that's going to make everything much more expensive for banks and financial companies, and it's across the board rate hike. That's even worse. We're going to see 1 to possibly 7% increase in the discount rate. The last time the Fed did this, increased the discount rate, we had a contrary reverse that happened, where the markets reacted by 500 points, free fall. I think that we're going to see in the later part, within the next month or so, you're going to see another boom that's going completely downhill. We're going to be skiing downhill, ladies and gentlemen. Better put on your ski boots and some serious pair of skis, because we're going to go downhill again. There's going to be some bright spots along the way. I'm not going to say that there isn't. We're going to see a few good things certainly above the neckline. Some certain companies are going to post some positive earnings, like IBM, and also Boeing and Microsoft. Verizon's going to chime in on that too, and from my market analysis, over the last, charting it long term, you're going to see that those are going to be some bright spots. But overall, we're going to have some serious weakness, ladies and gentlemen. I think that the 265-point average drop on the Dow this week just proved exactly what I've been saying to everyone all along. We're definitely have some weakness in the market, and the volatility, combined with the discount rate increase, is going to seriously hurt. As far as looking at the charting data, I want to get into that also. I think if you look at the charts, it's pretty conclusive, ladies and gentlemen. We're going to be free floating on an up and down bell curve, and it's going to show a lot of market volatility that way. Going to have a few sine waves that are going to peak at the top above the neckline, go right to the head too, top of the head. But you know what? There's going to be a downside to that too, and we're going to go not straight vertical, but will be a gradual slant downhill. But when you get to the bottom of the trough, you're going to see that people are going to realize that this is affecting everyone. That's when you get the knee-jerk reaction that they're going to bail out. But institutional investors, you got to take that into consideration always. You see, institutional investors are notorious for actually getting themselves in a jam, and then they cry foul. They pull the plug on things that they shouldn't be pulling the plug on. So we have to always consider what the institutional investors are doing, as well as the greater part of what the big corporations are doing. So if you combine that all together, you should be able to see on the underpinnings on the chart data that where the volatility is going and where is it coming from. Those are very important considerations. I think to add to it, there's serious other issues involved. We haven't even gotten the more housing data reports yet, which are going to show how much real estate is the real estate sector is being involved in it, because you definitely can't ever discount real estate out of it. Real estate's a major investment, and how well or not well that real estate is selling is a good predictor of economic growth or volatility. So that's very important also to pay close attention to. You want to also look at the top of the head too on where we're going as far as on the chart, to see if we're flat topping at all. Flat topping is always a sign that we're going to either do the next leg up, but on a bear market that's not going to happen. It's usually an indication that like on any stock, it's the market, any stock that you're investing in, that's a sure signal that you're about ready to go either one way or the other, up or down. So with the market as a whole, you got to consider also the aspect of how your investment portfolio is going to react to all of that. You better have yourself very well protected if you're in a bear market. Obviously, the opposite is true also in a bull market. You want a bull market, you want to be able to go ahead